very much, Alison. I will start. Well, what will happen as of January 1st, 2021, if the UK will be considered as a non-EU country from a customs and VAT perspective, in the situation that goods are being sold in a B2B? In this situation, we have a UK established business who is selling goods to businesses in the EU. The goods are moving from the UK into the EU. Well, the first thing that needs to happen is that the goods must be declared for export in the UK. Who will be responsible for that? Will that be the UK company? Or will that be the EU company, so your customer? As Alison and Andrew already mentioned, the Incoterms agreed upon are very important in this situation. Then when the goods are exported from the UK, the goods will be imported into the EU. Also then the question rises, who will be responsible for the import into the EU? Will that be the supplier, you as a UK company, or will that be your customer? Why is it so important? Well, at the moment of import duties and import VAT will be charged. Import duties are always a cost and cannot be reclaimed. So if import duties are charged, you must be aware that the prices will get higher. Import VAT is reclaimable. So import VAT can always be reclaimed. In some countries, there are even import VAT deferment schemes in place, like in the Netherlands. If you import goods into the Netherlands, in principle, import VAT is due at the moment of import. However, if you have an import VAT deferment license, the moment the import VAT is due shifts from the moment of import to your VAT return. However, if you are a UK company and you would like to import goods into the Netherlands and you would like to apply this import VAT deferment scheme, you will need to appoint a fiscal representative in order to do so. You are not required to appoint a fiscal representative in the Netherlands if you do not want to use the import VAT deferment scheme. The import VAT will always be paid back by the Dutch tax authorities. So questions that rises is, if you as a UK company become responsible for the import into an EU country, is do you need a VAT number? Yeah, you probably will need it. Do you need an EORI number in an EU country? Yes, you definitely need an EORI number if you are going to import goods into the EU. The Dutch customs authorities already provide at this moment EORI numbers to UK companies that plan to import goods into the EU. These EORI numbers are quite quickly provided, like within 5 working days at this moment. So make sure that if you plan to import goods into the EU in the future, so as of January 1st, 2021, you are prepared. One important note that I would like to make is that there is absolutely no need to set up a legal entity if you are going to import and sell goods from the EU, into the EU and from the EU. Often only a VAT ID number and an EORI number are sufficient. One thing that you should think about is, if the EU is a very important market for your business, is whether it would be possible to move stock from the UK to the EU and have some sort of warehouse set up in an EU country. In that situation, you do not have to deal with customs obligations every time you are selling goods to your customers, because all the sales of goods coming from that warehouse in the EU will be intra-EU trade, as you are currently already doing. Now let's move on to Jonathan and see what he says about the other way around situation, whereby goods are moving from the EU into the UK.
Thank you, Marissa. Good morning, everyone, or good afternoon, depending on where you are. So now we have the other way around, as Marissa said, with the movement of goods into the UK. Thinking about the conversations I've had with clients over the last few weeks as the inevitability of the end of the transition period becomes clear, one of the first things to stress is that irrespective of whether there is a free trade agreement, as has been mentioned before, that only deals with whether there'll be a positive rate of import duty. It doesn't deal with VAT at import. There are other things that we'll come on to that can cover that. And it certainly doesn't deal with the paperwork you'll need to complete to get the goods across the border, at Dover or Harwich or wherever it may be. So to focus on the bullet points, hopefully you can see on the slide in front of you, questions to consider are who's exporting to you, and are you buying from them? Are they your own goods? Who's importing into the UK, which is terribly important in terms of the recovery of import VAT. Is there any import duty payable? How are you going to deal with the payment of import VAT? Do you have a VAT number in the UK? And if you do, what should you do with it? Which I'll come to. Do you need an EORI number? Do you need a legal entity? And also to briefly cover the new e-commerce rules, which I'll come back to in more detail in relation to supplies to private and non-business buyers in the UK. So assuming that you're buying from a supplier within the EU, the first thing to consider is who's responsible for completing the paperwork to get the goods into the UK, points which Andrew and Alison have covered, and then whether there is any import duty to pay to get the goods into the UK. As Andrew mentioned, the tariff in the UK will not be the same as the tariff that we're using today whilst we remain in the transition period. So it's important that you understand what the import duty rate will be for the goods arriving. The payment of VAT at the moment, for any imports that any of you may make from territories outside the EU, you'll be paying import VAT either directly at import or through your freight forwarder or via your deferment account. As has been mentioned, the payment of VAT will no longer be due at the point of importation, as long as you include your VAT number on the customs declaration. And that's really important, in addition to your EORI number. That will signify that VAT is not payable at importation. And then what you do for those of you who want the granular level of detail, you put the VAT in box 1 of your VAT return, sales VAT, output VAT. You put the input VAT in box 4, as long as you're entitled to recover all of your input VAT, and you put the value in box 7, net of VAT. So that's the reporting of the VAT, and that's for all importations, not just from our previous fellow members of the EU, that's worldwide. So it's one of the few benefits, I suppose, of our departure from the EU on our exit from the transition period. So do remember your VAT number must be used in that way. You will need a UK EORI number because you can't use an EU EORI number because we're not in the EU anymore. So if you haven't done so already, go and get a UK EORI number. It's a very simple process. Just Google UK EORI and the application link comes up. Takes just a few minutes to deal with it. Similar to Marissa, there's no legal entity requirement in the UK. Although if you are the importer of record, so if you're an EU supplier to UK business customers, but you're selling DDP, the duty paid, then you are going to be liable to register for VAT in the UK because you're the importer of record of those goods into the UK. You can register as a non-established taxable person. The UK does not require a fiscal representative, so you can deal with that. I won't get into the detail of how you go about applying, but there are plenty of VAT people around within the MHA group who could help you with that, or Baker Tilly, more widely, of course. Now, the new e-commerce rules, which I will touch on now but come back to in a little more depth. If you're a business supplier to a business customer of goods that are of a net value of £135 or less, then you need to make sure you get the VAT number of your business customer, and that you also record on your sales invoice that the customer is going to account for VAT on your behalf, in order to avoid the alternative, which, as I say, I'll cover in more depth, that you will end up with a liability to register for VAT. This is a measure coming into the UK on 1 January, which at the moment the EU is bringing in largely the same sorts of, but obviously not identical measures in theory on 1 July, which Marissa is going to cover shortly. The significance of the £135, it's the euro equivalent in the UK equivalent, euro, EU limit, I should say, below which customs duty isn't payable. And in addition, as Alison mentioned earlier, low value consignment relief is being scrapped, so that basically a measure to be brought into the UK principally for e-commerce, principally for B2C transactions, to level the playing field. So to some extent, our departure from the transition period is not directly relevant. So I think I've covered, probably taken too much time too, but a lot to think about. The way in which business-to-business transactions happen from the EU to the UK post-transition period, and now it's back to Marissa.
Thank you very much, Jonathan. Well, let's now briefly discuss the VAT consequences when you are selling goods as a UK company to consumers in the EU. Currently, when you are selling goods to consumers in the EU and you are selling, you're also transporting these goods to the consumers, so you're sending these via parcel service to these consumers. Distance selling regulation is applicable. So currently, either VAT is due in the country of departure of the goods or in the country of arrival of the goods if you breached a certain threshold. Well, as soon as the UK leaves the EU, all these supplies of goods, so as soon as the UK is being considered as a non-EU country from a customs and VAT perspective, all these supplies of goods will also be an export transaction out of the UK and an import transaction into the EU. The question which then comes up is, who will customs clear the goods into the EU? Will that be the UK company, or will that be the consumer? And if it's the consumer, so your customer who purchased online goods on your web shop, who purchased goods on your online web shop, is that customer aware of the import duties and the import VAT that he or she must pay when they purchase these goods? And what is the website saying about the pricing? So if the consumer is buying something for £100 and they also must pay import duties and import VAT, for example, in the Netherlands, that price will rise significantly. And if the consumer is not aware of that cost beforehand, this could mean a commercial issue. So if you are selling goods to consumers in the EU, make sure that your website is updated. Make sure that it is clear from your website who will be paying the import VAT and import duties, especially if the customers, the consumers, will be responsible for that. Then, as indeed already Jonathan mentioned, in the EU, new VAT regulation will become applicable in principle as of July 1st, 2021. Based on this new regulation that is announced, the distance selling regulation will no longer be applicable. Of course, this new regulation only works for supplies of goods to these consumers in the EU. If you are selling a lot of goods through your online shop to consumers in the EU, it might also, for these sales, be worthwhile to reconsider your stock location. Why? Because if you are selling the goods from a warehouse, for example, in the Netherlands to all these consumers, you can still use and apply the new EU VAT regulation, because that new EU VAT regulation will contain an element which is called one-stop shop regime. VAT will be due in all the countries where your consumers are living, but you do no longer need to register in those EU countries. You can report the VAT due in all these countries to the one-stop shop return that you will then file through the Dutch tax authorities. It could be a great facility to use in the future. Now let's move over to Jonathan again and see how it will look like if you are selling goods through an online shop from the EU to the UK.
Thank you, Marissa. Here comes the heavy lifting. There are so many changes happening. And as I said a few minutes ago, in part, these changes to e-commerce transactions are not really linked to our departure from the EU or the transition period because they deal with supplies from anywhere. But we are dealing with them at the same time, so it's a one hit for everything, really. So the points to cover. The distance selling regime, as Marissa said, can no longer apply for goods from the EU coming to the UK because we're not in the EU and it's an EU regime. All supplies of goods coming from the EU to the UK will be an export from the EU and an import into the UK. But those words, export and import, cover an awful lot of moving parts, which I'll come to shortly. Is the supply below £135? And there's a point to note there that 135 is net VAT. So if the goods are liable to 20% VAT, the rate of VAT in the UK, then the cash price is £162. And payment of the import VAT and import duties, you do need to think about whose responsibility that is, but the rules that I'm going to cover in a second, you'll see that most of that, there are rules for the way in which that will happen. Pricing on the website, yes, needs to be accurate, and that is the relevant price for the payment of VAT. So, without further ado, the much trailed new rules. So, from the 1st of January 2021, for goods of a net value of £135 or below, the sale of those goods will result in a liability to register for UK VAT. And that liability will arise or liability to account for VAT, I suppose I should say, and therefore a potential liability to register if you aren't already registered. And that liability will arise for either the online marketplace, if they are facilitating the sale, which I would read in simple terms as that's the way in which you buy the goods, and that's the process, Amazon, eBay, Etsy, and others. That's the way you buy the goods. So if they're sold via an online marketplace, then the online marketplace accounts for VAT. If they're sold on your own website, then you need to register for VAT in the UK. That doesn't mean that import documentation has gone away, though we're told the way in which that works will be simplified somewhat. Still will be fiscal checks on the way in which the goods enter the UK. The registration, so let's walk through. If you're not an online marketplace, you're using your own website to sell goods into the UK, you're based in Germany, and you're selling goods whose normal retail price is around £50. At the moment, you may well have a distance selling VAT registration in the UK if you've exceeded the UK threshold of £70,000 for registration as a distance seller. That distance selling VAT registration you currently have can continue to be used for the sales of goods into the UK from 1 January. There's no need to reapply for VAT registration. And you would continue to account for VAT in the UK from next year. If your goods are already in the UK, you should already be registered for VAT. But if you sell via an online marketplace, then it's the online marketplace's responsibility to account for VAT. Your sale to them, and this is important, if you bring goods into the UK, into, let's say, an Amazon warehouse in the UK, and they're stored there so that they can be shipped for next day Amazon Prime delivery, then you've brought a bulk consignment of goods into the UK, not for any individual customer. That's an import. In order for you to be able to account for VAT on the import on your UK VAT return, as I outlined earlier, you will need a UK VAT registration. Because the online marketplace is deemed to be the seller of goods to your customer in the UK from a contractual perspective, you will need to understand how to treat the sale of goods to the Amazon marketplace, to Amazon, I should say. That'll be treated as a zero-rated supply. That will allow you to do the box 1, box 4, box 7 of the UK VAT return I mentioned a few minutes ago. That will also give the transaction some reality from a VAT perspective. And then Amazon will account for VAT on the sale of those goods to your customer. And for Amazon, obviously, read eBay, etc. I hope that's clear. It's quite a lot of detail to get through. You will also have business customers from time to time, I'm sure, that will buy either directly from you via a marketplace, perhaps both. I can think of one of my clients, for example, who's got pretty much every possible permutation of the way in which their goods are sold. Some cases straight from the Philippines, some cases in their own warehouse, on their own website, on an Amazon website, in an Amazon warehouse. And it's important, if you are transitioning between different ways of selling, or you have multiple ways to market, that you can map each of these transactions. So to deal with business customers, if you're selling to a business customer who gives you their VAT number, and the sale, as I mentioned before, is under £135 net of VAT, then your business customer accounts for the VAT in the UK, as long as they gave you their VAT number. And if that happens through an online marketplace, that sale to a business customer in the UK is not the responsibility of the online marketplace, it's yours. So there's another wrinkle. I'm sure if I were on the receiving end of listening to this section of the presentation, I would not capture all of this information and retain it. There is actually quite a helpful HMRC, put it on my second screen, HMRC press release that covers this. If this is you and you're dealing with these issues, I do recommend you have a read of it and try and work out where it leaves you in terms of your UK VAT obligations. There's one other point I should mention. This doesn't cover Northern Ireland. If you're selling goods from the EU to customers in Northern Ireland, none of this applies, because Northern Ireland is in the EU as far as these rules are concerned. So they continue to be a dispatch from the EU and an arrival into Northern Ireland. And I use those words on purpose because that also covers intrastat obligations, which will continue next year. It will continue in the UK for arrivals only, but for Northern Ireland and the EU, they'll be in place, I assume, on a permanent basis. I think I've covered everything. Just checking that I've run through it in an appropriate order. I'll hand back to Marissa, I think.
Thank you very much, Jonathan. Here we are with the simplifications. As of course, January 1st, 2021, when the UK, will no longer be considered as a non-EU, as an EU country, and will be considered as a non-EU country from a VAT and customs perspective, be aware that some simplification rules will no longer be applicable. So if you have call-off stock in the UK at a customer, currently there is a simplification in place for these stocks, and you do not have to report a transfer of goods. You have a local sale. Well, those simplifications will no longer be applicable. So make sure that if you have call-off stock in the UK, the simplification will not be applicable anymore. If you install goods in the UK, currently there could be simplifications applicable. Be aware, they're no longer applicable after January 1st. As of January 1st is what I should say. Also, if you are involved in triangular transactions involving EU countries and the UK and moving goods, make sure that the current simplifications that are in place are no longer applicable. Alison, I'll hand over to you.
And I apologise, Marissa, that was my slide. Thank you for dealing with it so professionally.
Hi there, can you hear me okay? Yes, you can. I just wanted to raise with you all some key issues that are nothing to do with VAT and customs duty, and are kind of putting a bit of a spanner in the works and causing businesses who are affected with lots of other challenges and concerns. So the first point is the labelling and packaging legislation. So particularly for food business operators, they are finding that to deal with EU legislation, they have to arrange for a label to be on their goods that are sold in Europe that has either the importer's name and address on it or their EU address on it. Now that's a bit of a problem. Often, if you sell Ex Works, you're not going to be the importer. You're going to have a whole load of different customers who are going to be the importer into Europe. You can't put all of their names on the labels. So, what we've been looking at is what we can do in Europe to have a name and address over in Europe, so we can order our labelling and all get on with life. It may be that you have a single EU distributor over there, and maybe they could help you, and they may be the importer, in which case your problem is solved. Alternatively, it's not as straightforward if you're an overseas business just to go and get an address somewhere and hire something without having sort of other things in place. So one solution is to set up as a sort of quite light touch company, courtesy of using a representative's address as well, in order to be able to get around that particular problem. But I think particularly for food business operators and other sectors where you need labelling, this is an issue that if you haven't looked at it, it really needs to be looked at. And I think that going on to CE markings, as of the 16th of July next year, CE mark legislation require an EU establishment. So that would be if you had an EU establishment, it would be your EU subsidiary, or it would be an EU branch that you had over there. You would need to have that on all your sort of packaging and sort of all the instruction cards, etc. Or you have to appoint an authorised representative who can deal with it on your behalf. So that's only 6 months in, and I think that these issues are going to be matters that then cause that longer term strategy and discussion that Patrick will come on to about whether or not you do need an establishment in Europe to get around these types of issues. The same legislation, UK CA marking, will be coming into the UK, but there is a much longer transitional period. So CE markings can still apply to goods that are sold in the UK until January 2022. But there again, there will be similar legislation to Europe, where you need to have a UK establishment on your markings or an authorised representative. One final point before we just head back for the last bit of roundup on VAT on services. Key administrative issues for you to look at. Have you got a customs agent? If you haven't, let us know. We can introduce you to one. Can you deal with your declarations? And that is all around making sure you've got the right commercial paperwork in place. Again, give us a shout if you don't have that, or you want to check that you've got the right stuff. Marissa and Jonathan have been talking all about being registered for VAT over in Europe. Think about a representative over there. In a lot of countries, you will have to appoint a fiscal rep now that we're not in Europe. For example, Belgium, you have to appoint a fiscal rep. And things like bank guarantees go with that, so it can be very costly. So places like France and the Netherlands at the moment don't require that. Same with Ireland, but there may be changes coming along that you need to be aware of, that a VAT registration may also go hand in hand with a fiscal representative. Bear in mind, finally, that HMRC have provided some really valuable grant funding to support UK businesses that are predominantly dealing with European trade at the moment and who are going to really struggle with getting to grips with this wholesale change about how they're going to do business on an international basis. There is grant funding available for training, grant funding available for businesses to purchase software licenses, and grant funding to help you recruit somebody who's going to deal with your customs duty in-house for you. If you want any information on that, please do get in touch, as I will be able to help you through that. Now, back for our last section on VAT to do with services. Marissa, Jonathan, back to you.
Thank you very much, Alison, again. Well, indeed, back to the services. If you are providing services in general, from an EU VAT perspective, you must check whether your customer is a business or a consumer. And then the second thing that you must check in order to determine the VAT consequences is which services are you providing. There is one type of service that will become particularly interesting as of January 1st, 2021. And those are the electronic services. So if you are providing electronic services as a UK business to consumers in the EU, VAT is due in the countries where the consumers are living. So if you, for example, are providing streaming services or selling online games as a UK company to a consumer in the Netherlands, VAT is due in the Netherlands by the UK company. Currently, a UK company who pays this VAT due in all the EU countries where the consumers are living can pay that VAT through a mini one-stop shop return through HMRC. However, as of January 1st, 2021, that mini one-stop shop return will no longer be available at HMRC. So a UK business who needs to pay VAT in other EU countries can no longer do that through the MOS return. If a UK company is providing these electronic services to consumers in the EU, it should register in an EU country for MOS. So for example, as of January 1st, 2021, if the UK company is providing these electronic services to consumers all over the EU, it is recommendable to, for example, register in the Netherlands and apply there for the mini one-stop shop system. This in order to prevent registrations in all EU countries where these consumers are living. So make sure that you register on time for applying this MOS system in another EU country. Now let's go to Jonathan and see how it works the other way around.
Thank you, Marissa. Yes, that's me. So points to cover here. Electronic services, covered there in brackets about what they are, and I'll come on to one particular aspect of that shortly. VAT due in EU country of consumers at the moment. Payment of EU VAT due via MOS return at the moment, but won't be from next year. And B2C to UK consumers, UK VAT will be due, yes. And that non-EU MOS can no longer operate from the UK, which could be a common place for people to have registered from a non-EU perspective, and that will need to change. So I guess the starting point is that supplies of services that are electronically supplied and used and enjoyed in the UK are taxed in the UK. And that is legislation in place today that will continue post the transition period on 1 January 2021. At the moment, as Marissa very helpfully set out, there are EU provisions that deal with the way in which that VAT is accounted for, that of course will no longer apply from next year. So if you are a supplier of online media, apps, streaming, online books or online games, then your place of supply of those services becomes the UK. And you will need to register for the UK VAT to deal with your obligation to pay that back to HMRC. One point to note, we have in the UK very recently introduced a zero rate for online publications. So if you are supplying those, and that is all that you're supplying, unlikely, but if that is all that you're supplying, then it may well be that you, on the face of it, have an obligation to notify HMRC that you are in theory registerable, but you can apply for an exemption from registration on the grounds that you're not actually liable for a positive rate of VAT. And as long as you have no UK expenses that you wish to recover VAT on, then that's the end of that, I would suggest. But for anything else electronically supplied, you'll have a UK VAT liability. The way in which that's dealt with, again, can be as a non-established taxable person. And therefore you don't need a fiscal representative, as I mentioned earlier, and you don't need a UK establishment branch. But you do have a liability to register. If you're using the UK at the moment to file your non-EU MOS return, you obviously can't do that anymore. So you'll need to find an EU territory in which to continue to do that from January next year. And finally, if you're, Marissa covered this, but I started the sentence, if you are a UK supplier supplying into the EU, then obviously you're going to have to think about that too. So that covers, I think, the points I wanted to make. I think I hand over to Alison this time. No, I don't. No, it's me. Trip me up a second time. Other points quickly to mention. If you have EU VAT you wish to recover, you have until very precisely 11 PM on March the 31st to recover that VAT under existing rules, because we're still in the transition period, we're still covered by EU rules, so you can still use that process for one final time. But for any VAT you incur next year, well, we'll be a non-EU business, and there is obviously a process in place for non-EU businesses to recover EU VAT. Those rules, I don't intend to get into them obviously, but they're not precisely the same. So you need to check what your position is in relation to a non-EU business. There isn't yet, unless I've missed it, any clarity on what the position will be for EU businesses recovering UK VAT. I expect there will be a process broadly the same as the one we have today, but we'll have to see. We have the equivalent of, well, yeah, called the 13th directive, for those who know what the 13th directive refund procedure is for UK businesses, for non-EU businesses, I should say, recovering UK VAT. Whether that will fall into line, we'll have to see. Yet to be determined, but probably, I would say. I think I now do hand over to Alison. I don't think I have a third slide I've forgotten about.
Thanks, Jonathan.
Okay.
Final thoughts from us. Thank you for bearing with us. There's a hell of a lot of indirect tax issues to deal with, as Patrick said. So key things to do if you haven't done anything yet. Check that commodity code checker. Get your Intrastat forms and go on hmrc.gov.uk, tariff checker, and check it out. That'll give you a lot of sort of starting point. If you need an agent, get in touch with us. If you need a fiscal rep over in Europe, please do get in touch with us. If you need any help with VAT registration in the UK or overseas, we can help you. Please be aware of that labelling legislation and start thinking about the CE markings and whether or not you need to start thinking about more of a different structure, and on which case I'm going to hand over to Patrick, who will be talking about that point. Thanks, Patrick.
Well, thanks. Excuse me. Thanks, Alison. In fact, I think we were going to have, I thought we were going to have Richard do a little bit on personnel now, but okay, I'll carry on straight away with this. No, sorry. We can go back to Richard's slide. He's joining us by phone because of our technical issues, but he will go quickly through these people changes. Thanks, Richard.
Thanks, Patrick. And yes, hopefully everyone, you can still hear me even though I'm not on screen. Just really quickly on people issues coming out of Brexit. Of course, they are many and varied. This list isn't exhaustive, and there are lots of different permutations of the challenges your business could be facing. Often, of course, developing a robust response to these challenges is as much about addressing the practical commercial factors as it is any of the tax technical issues. So first and foremost, understanding the reach of your UK EU workforce. That's really about getting a handle on which of your employees will be impacted by Brexit. So really understanding which countries are your UK employees currently working in, and also which countries have you got EU nationals have come from into the UK. How long are their assignments? When are they due to finish? What are the current contractual terms? And can or should any of those be brought to an end early, or have their terms varied? Thinking about future workforce requirements, so, you will have if you've got people moving between the UK and the EU, you already have a pipeline for those future moves. And again, understand which jurisdictions are involved. If you know that employees are due to come from certain EU countries, find out, have those countries put in place any special measures looking forward to help people come to the UK post-Brexit, and do try and access that local support or guidance as soon as you can. The point about budgeting very much speaks to the commercial factors I mentioned a moment ago. So do think about what extra costs need to be budgeted for people moves, and do those moves actually still make sense commercially in light of that potential commercial impact. For immigration, from our discussions with clients, immigration issues are absolutely front and center for many employers in this Brexit landscape. And whilst we can see them as mainly employee issues, actually many of our employers are looking to proactively support their people where time and costs allow for it. So we're thinking here, of course, about non-UK nationals in the UK. If they've been here for at least 5 years and then got that continuous legal residence, then they can look to apply for permanent residence. If they've been in the UK, resided here for less than 5 years, then that potentially is going to be the EU settlement scheme that they could apply under to continue living in the UK post 30 June next year. Your business could also consider applying for a sponsorship license if it wishes to hire non-UK nationals, and think about how the rules have changed under that regime, which may actually make it more attractive than before. Some of the roles that previously weren't eligible for sponsorship may be eligible from January. Social security, I could almost do an entire presentation on the social security impact of Brexit. So I'll keep it to some of the really key issues. And there is, again, continuity here with the point I made about the cost pressure of Brexit on your people budgets. When we do leave the UK, is there going to be a replacement for the A1 certificate program? And you might know that allows you currently for employees to continue paying into their home country social security system for the first 24 months of an assignment to another country. And this avoids dual contributions, but without an equivalent program post-Brexit, there could be that exposure. Your employees won't want to take that financial hit themselves, and will they be pushing those costs back onto you? Similarly, with healthcare and insurance costs, they could be much higher post-Brexit if employees going from the UK don't have access to the European health insurance card, for example. Will you mean you'd have to purchase additional health insurance for them? And the flip side of this is EU nationals in the UK may become liable to pay the immigration health surcharge in order to access the NHS. So again, it comes down to extra costs, extra compliance, all of which may act actually as a disincentive to these people moves in the first place. I'll skip over international remote working. That's not solely a Brexit issue, but it's certainly flavour of the month with many of our clients. If you do have any questions or would like to discuss that further, please do reach out. And it's back to Patrick.
Thanks, Richard. We are a bit short of time. We have quite a few questions, so I'm going to try and skip through my bit very quickly so that we do have time to deal with at least some of those questions. Next 10 minutes or so, perhaps a bit less, I'll be talking about how direct tax is impacted by Brexit, whether you need to think about your structure, whether there are any changes you need to do. So the first slide is, as it says there, what changes? Well, there are a number of areas of EU law which you've become very used to and which help with international structures. So the Parent Subsidiary Directive and the Royalties and Interest Directive that you see on that list, they allow a subsidiary in the EU or a company in the EU to pay dividends to its parent in the UK or elsewhere for that matter, without any withholding tax in the local state. So both of those are going to disappear, assuming we, at the end of the transitional period, do not have a deal which allows them to continue. So the assumption is we will no longer have Parent Subsidiary Directive, the Royalties and Interest Directive, and that's probably a bad thing, but I'll say in a minute why perhaps it's not as bad as it first seems. So withholding tax on dividends paid from a company in France, say, to its parent in the UK, may become relevant again from the 1st of January next year. When we move on to the other directives mentioned there, Directive on Administrative Cooperation, or DAC for short. Some of you may have received notifications from us about a directive from that group called DAC 6, which is, in my opinion, an awful piece of legislation. It's intended to allow the EU to gather information to minimise the amount of artificial movement of goods and services between states for tax advantage. The problem with it is it's so widely drafted that it captures all sorts of perfectly normal transactions, and it gives rise to a reporting requirement for which there are penalties if you get them wrong. Us as the agent, but potentially you as well as the person or the business dealing with it. So that's something I'd rather be out of. Unfortunately, the UK took the view to sign it into our legislation already, so we are going to be continuing with that, even though we will be outside the EU completely from next January. Anti-avoidance, that's an area, again, where the EU and the UK run fairly parallel lines anyway, and the EU brought in legislation which largely mirrored legislation the UK already had. One area where there may be some loss of flexibility, I suppose, is with dealings with the United States, obviously a very big customer of the UK, a very big trading partner of the UK. The treaty we have with the US has a limitation of benefit clause, which currently, because we're in the EU, sort of in the EU, and the EEA until 1st of January, it doesn't really apply to us. It doesn't really apply to UK companies. From the 1st of January, it's likely there could be some further restrictions caused or some further likelihood of the limitation of benefit provisions applying. So where you are trading with the US, and relying on the treaty provisions perhaps for some of your transactions, it's worth looking at again following the beginning of January. On the good side, Parent Subsidiary Directive and Royalty and Interest Directive, the loss of those, as I say, is quite bad, but the reality is the UK has a very wide tax treaty network, including with virtually all, if not all, EU states. And what will happen once we no longer have the benefit of those directives is that we will simply fall back on those existing tax treaties, which in many cases largely mirror those directives in any case. If you look at France and the Netherlands, for instance, two fairly big trading partners of ours, the position after we come out of the Parent Subsidiary Directive and the Royalties Directive is exactly the same. There is no withholding tax on dividends, interest or royalties under those treaties. If you look at Germany, it's the same again for royalties and interest. There's no withholding tax, but there may be a small withholding tax of up to 5% on dividends. So not too bad, but a little bit worse than it is now. If you go to Italy, it's not quite as good again. There may be some dividend withholding tax up to 5%, up to 10% on interest, I think it is, and maybe up to 8% on royalties. So you can see that although the loss of those directives is not good news, the treaties we have, to some extent, and in some cases completely, mitigates that. And we are aware that some EU states have already said that if we don't have a deal whereby we can no longer take advantage of these useful directives, they will change that treaty with the UK so that we can continue to benefit from those same rules. So not too bad. If we go to the next slide, please. But does anything need to change? You've already heard from Alison that there's no need to have an EU-based company in order to take the benefit of some of those VAT and customs duty matters that she and the others were describing. And that's definitely the case. It's a fallacy to say you need to have an EU subsidiary in order to continue your business. If you are a UK-based business, you are trading with the EU, it comes down to some number crunching as to whether it's worth the cost of setting up an entity in the EU. Number crunching is one part of it. You're going to have some costs on tariffs, as Andrew was explaining. Are they big enough to warrant the cost of setting up something in the EU? Quite possibly not. Most of our clients actually have not done so, but some do. And often it's not so much the cost that's the problem, but the delays at the border caused by customs checks. If they need to get product to market very, very quickly, they perhaps need to set up something in the EU to allow that to happen without having to cross borders all the time. And again, it was mentioned during the earlier conversation that you can do that by having a warehouse in somewhere like the Netherlands, which allows you to store some stock, which you can then transfer to EU clients into EU without having to worry about the border for those onwards transactions. So that is what quite a few people have done. If you're looking at a company that does have EU subsidiaries already, so a larger group, then you may need to start considering whether you need to restructure a little bit just to make sure that you're not losing out on withholding taxes. If you remember the previous slide talking about the parent subsidiary directive, etc. If you are you're in one of the unlucky places where the tax treaty doesn't help you too much, then there may be things you can do with structuring to minimise any loss on withholding taxes on repatriating funds to the UK. If we move to the next slide, please. So what do you need to do in the EU if you decide you do need a presence there? Just very briefly, we've mentioned the possibility of simply having a warehouse. Now, you can have a warehouse full of your stock, which you use a third party to transfer on to customers as and when they require it. And you can do that in such a way that you get round the VAT and mainly customs issues because you do have a base in the EU, but not actually have to have a presence for direct tax purposes in the relevant state, whether it's the Netherlands or elsewhere. So that's probably the first thing to consider if it's simply time on movement of stock you're worried about. If you want to go further than that, you do need people on the ground of your own, then you may need to set up some presence there. You don't necessarily need a local entity though. You can start with a branch whereby you will have a taxable presence in the state concerned because you have people there and you have a presence there, but you don't actually need a full-on subsidiary. If, on the other hand, there are reasons, regulatory or otherwise, and I just mentioned CE marks and so on and trademarks, there may be sufficient reason, there may be sufficient value in having a local subsidiary, so you set up an actual company in the location concerned. But the real message is you don't need one unless the numbers, when you do the number crunching and you see the costs of operating without one, justify it. So next slide, please. I just wanted to very quickly explain or reiterate why the UK still remains a very good location for a holding company, whether you're an international business with a UK sub-holding company or a UK group with international expansion in mind or already underway. You may well have heard an awful lot about perhaps companies, and some companies have moved from the UK to other locations for tax purposes. In fact, the UK remains a very good location for a holding company, partly because we have a very extensive tax treaty network, as I mentioned, which allows you to get mitigation of any loss of tax from local rules because the treaties iron out those differences. We have a foreign dividend exemption, which means that a UK company can receive dividends from its overseas subsidiaries without paying any UK tax on it. In most cases, certainly any country we have a treaty with, that's the case. We have a substantial shareholdings exemption, which means a UK holding company can dispose of its shares in its subsidiary without paying any UK tax on the gain, and it only needs to own up to 10%. As long as it owns 10% or more of a company, then it can qualify for that relief, which is very useful. We charge no withholding tax on dividends, so where the UK is used as a stop-off point on the way to another state for the transmission of profits, the UK itself does not charge any withholding tax on dividends, so money can be repatriated to a holding company in the United States, Australia, or wherever it may be, and we don't take any tax off that. The UK has a very favourable regime for incentives in research and development, patents, patent box rates, giving very low tax rates there. We, as a general rule, have one of the lowest, if not the lowest, corporation tax rate in the G7 and G20 at 19%. That remains very competitive. And since 2017, we have very flexible loss rules as well. So we have seen some clients bringing back to the UK IP companies within their groups to realise more profit in the UK, such that they can use up UK losses, because it's now, our regime is now so flexible that losses can be used against any other income. So there's some very good tax reasons or fiscal reasons why the UK remains good. And if we go to the next slide, we can look at some non-tax reasons as well. Sometimes for those of us living in the UK, perhaps this doesn't seem to be quite so true anymore, but I think it is still true in relative terms that there is a fairly good economic and political stability in the UK. Despite our little foibles, we are still pretty stable. Our legal system, again, like any other, has its issues every now and then, but it's a very well-renowned and respected legal system around the world. We have a flexible labour market compared to many countries, perhaps not quite as flexible as the US, but probably generally seen as more flexible than a lot of the EU, so that can be very helpful. Great cultural diversity in the UK. That is often seen as an advantage, and it does allow us to interact with states in all parts of the world with a greater understanding than some, perhaps. We have very strong and credible capital markets, which sits behind a lot of business. And one thing I added in, mainly because I thought it was interesting, but is that we have a relatively young population, and that is something that's going to be becoming increasingly important over the next couple of decades. If you look 10, 20, 30 years into the future, it's projected that the populations of countries like Germany, Spain, Italy will plummet due to falling birth rates and ageing population. The UK has a relatively low age because we have a significant immigration, and that has kept our average age lower. For instance, if you look around the world, the US, which is traditionally a state with a lot of immigration, although current times are perhaps a bit different, they have an average age of their population of, I think it's 38.3. The UK is fairly similar at 40. But if you go into the EU, a number of the states there, most of the major states there, the average age is over 45 and pushing towards 46. And very few of them are much below 45 as an age, which kind of bears out the truth of that statement, that we have a young population and the ability to maintain our population going into the future. I think there's one more slide, please. So in conclusion, Brexit will change the relationship between the UK and the EU, but you do not necessarily need to change the way you do business. Many businesses are not. But review your business, determine how you're impacted, look at the numbers. We can obviously help you with that. The sooner you start, obviously, the better. If you haven't done anything yet, don't panic on the direct tax side. I think your worry should be focused more on the indirect tax side, as Alison was saying. But the UK does remain a good place to do business and establish a company. You may want an EU presence, but it depends on the numbers. Review and plan. That's the message, and we are here to help. And I think now we better go to some questions, because we have obviously nearly run out of time. Oh, sorry, there is one last polling question. Which of the following would you like to hear more about? I can no longer see it because the polling's go up there, but if you'd like to give your answers, that would be very useful. Just give you a moment for that. Right, thank you. While you're all tapping away, I think perhaps we'll move to some questions so that we can get through a few at least before we run out of time. So, let's see what we have here. Well, I shall just pick a question. and I think these are probably mostly going to be for the VAT and indirect tax guys. So I'll ask the question, and perhaps you could, the one who wants to answer can pitch in. What will happen to temporary export and import of used goods? We are a touring theatre company working throughout Europe who need to take our props, costumes and scenery in and out of the UK and between other European countries, e.g. between Holland and Germany, without coming back to the UK in between.
Patrick, I think there's a couple like this actually, to do with temporary movements of goods in and out, and one for Andrew to answer.
Thank you. For those particular instances, I would suggest that perhaps the carnet system would be best used to move the goods about, because you won't be able to freely move the goods within the EU. So if you're going to be moving from the UK into Holland, then on to Germany, the carnet system, I think, would probably be the best way of doing it. Obviously, we'd need to know the extent of all the props, costumes and scenery, but that would be my sort of suggestion on that, to be able to move those goods about under cover of a customs document. So each country would stamp it up, but you would, from my understanding, need to know where they're going to go, which countries are going to be used, because that needs to be part of the carnet. The number of different countries that are required. So
there wouldn't be any customs duty paid on
no,
those?
I think
you'd be able to move them through without paying anything?
There would potentially be a security required, because one of the things that what is required is the goods go out for a certain period of time, for 2 years, for instance, but the carnet has to be returned back into the UK and stamped, so that it can be confirmed that the goods have been returned. One of the things that HMRC tend to get is a request to do a certificate of location. So they would get the carnet, have to go out to that company who submitted the request for the carnet and check that the goods were in the UK, so that it would discharge the security, or it would discharge the security.
So you can move them, but you might have to pay an amount up front in order to be able to do that. And as they come back into the UK, then that would be given back to you. Yeah,
best people to speak to on those are the Chamber of Commerce, because the carnets, I think, go through the Chamber of Commerce system rather than through HMRC.
Thanks very much for that. Having had a quick look through the questions, I can see that they are all customs and VAT related. So it may be better if I hand over the picking of the questions to Alison. But I just say we are pretty much out of time. So perhaps we can have 2 or 3 more questions, and then we better draw ourselves to a close. So, Alison, I don't know if you'd like to pick a couple of questions for you or Andrew to deal with, and then hand back to me to wrap up.
I think there's been a couple of questions, Andrew, on inward processing relief. So if inbound duty is not liable on the import of goods, is duty liable on the repair, calibration cost, and when and how is that paid?
So if you're importing goods say, for instance, you've got a machine that's coming from Germany into the UK for repair, it would be imported under inward processing relief, where no duty and VAT is paid. When the goods are re-exported, that discharges the UK company's liability for the customs duties. When the goods go back into the EU, the company in Germany, for instance, would, if they didn't export it correctly and import it under outward processing relief, could be liable for the full rate of duty on that repair. So it's a two-way thing. It's making sure that if you're exporting those goods out for repair, that you temporarily export them, and when they come back in, you either apply for outward processing or simplified outward processing, or have an outward processing application. But if it's just the ad hoc one, it would be the simplified version of it. So under outward processing, you'd only pay for the cost of any repair or labour costs incurred outside the EU.
Thanks. And I'm going to pick one up quickly, which is all about ex-works again. So anonymous attendee, thank you for your question. You're absolutely right that, you know, that the export evidence is key in ensuring that you can zero rate that sale to your customer. to treat it as a zero-rated export. Now, if it's ex works, you're not going to be declared as the exporter on the HMRC system. So you really must make sure that you have evidence from your customer. And that would be, I'd be insisting on a stamped CMR form, an airway bill, or a bill of lading in order to support that zero rating. One final question, I think, is a fiscal rep required for exports from the UK to France? The answer to that, Chris, is not at the moment. In France, we are not required to appoint a fiscal rep in order to be registered for VAT. But what you have to, as Marissa and Jonathan were saying, you need to establish if you're going to be delivering duty paid, in which case you may have to register for VAT in France in order to be able to deal with the import VAT and claiming it back. Patrick, back to you.
Thanks very much, Alison. I just want to say thank you to all our presenters today for a sterling job, particularly with the technical issues, which I like to think we kept largely secret from the audience, but apologies for any that tipped over into it. Thank you to all those people that attended as well. I hope you found that interesting and informative, and as I said at the start, not too scary in places. Thanks particularly to Joe Nellis for his bit at the start. As I said then, I think it's always interesting listening to where we're going, and to hear it explained in such a calm and confident manner is brilliant. So the final thing I'd say is we are here to help. So some of this stuff is quite tricky. Some of it's very detailed, as you've seen, particularly on the VAT and the customs side. So please do come to us and ask for help if you need it, and we will do our best to help. So thank you very much. And that is the end of the session. Thank you.